Hello and thank you for joining us for this edition of our market briefing. Today we will discuss the recent drop in corporate earnings and what it may mean for the future path of stock prices. More specifically, we will look back at prior earnings contractions to draw some conclusions about what to expect going forward. Let's start by looking at the recent drop in expected annual earnings for the S&P 500 companies. Following strong growth in recent years, we can see the sharp decline in earnings this past quarter. With shelter-in-place orders issued and many businesses suspending operations, estimated annual earnings are expected to drop 13.8% during the first quarter. If this is the actual decline for the quarter, it will mark the largest year-over-year drop in earnings since the 15.7% contraction in the third quarter of 2009. This next slide shows all the earnings contractions over the past 70 years, highlighting the peak-to-trough decline in earnings during each episode. We can see that the peak-to-trough declines average between 20 and 30%, with some smaller contractions and some much larger. Notice that the average has increased in recent decades following much larger declines of over 50% in each of the last two economic recessions. One commonality among all these past contractions was their long journey to recovery. This chart drills into the annual earnings level in each of the last four earnings contractions. As you can see, it tends to take 3 to 4 years before earnings recovered to their prior peak levels. It also highlights that the trough in earnings sometimes comes a year or two after the initial decline. So why is all of this important? While we cannot predict the direction of stock prices in the short run, we do know that stock prices tend to follow earnings in the long run. This chart helps demonstrate that principle. We can see that sometimes stock prices get ahead of earnings, such as in the late 90s, and sometimes prices may lag behind earnings, such as in the recovery following the recession in 2008. But that in general, prices follow earnings over time. If we look closely at the recent trend in the upper right corner of the chart, we can see that the gap between the direction of stock prices and earnings has widened significantly. Looking ahead, we would expect this gap to close over time as earnings trends become more certain. The damage of this pandemic has greatly affected the U.S. and global economies and corporate earnings, but the length and scope of its impact is still to be determined. It is important to look back at past market shifts to understand that recovery is not a steady, linear process. At RMB, we recognize corrections are a normal part of investment cycles. In the long run, we know that stock prices tend to follow earnings trends, and we look forward to gaining more visibility on corporate profit trends in the coming months. From all of us here at RMB, thanks for tuning in. We hope you're able to join us for our next market briefing.